There's a strange calm in the American economy right now. On the surface, everything looks fine. Strong growth, low unemployment, busy shopping malls, consumers still spending like nothing's wrong. And yet, something underneath is starting to crack. Because the Federal Reserve's favorite inflation gauge just came out, and it's telling a story the Fed does not want to hear. Chapter 1. The number that won't go away. The number is 2.8%. That's where inflation stands, according to the Personal Consumption Expenditures Index, or PCE, the Fed's preferred measure. In November, both headline PCE and core PCE landed at 2.8% year over year. October quietly revised up to 2.7%. This isn't progress. This isn't cooling. This is inflation digging in its heels. The Fed's target is 2%, and that target now feels less like a destination and more like a mirage in the distance. After multiple rate hikes, after 3 rate cuts, inflation isn't falling anymore. It's hovering, stubborn, uncomfortable. And that's where the real problem begins. Chapter 2. A boom built on a contradiction. Because at the same time, America looks strong. Very strong. Third quarter GDP grew at an eye-catching 4.4%. Unemployment claims, the lowest in 2 years. Retail spending, still charging ahead. The headlines practically write themselves. The U.S. economy remains resilient. Inflation is sticky but manageable. Consumers are holding up just fine. On paper, this is a Goldilocks economy. But paper has a way of lying. So let's look closer. Chapter 3. Income versus spending, the quiet imbalance. Here's where the contradiction starts to show. In October, personal income rose just 1.1%. In November, it improved slightly, 0.3%. Both figures came in below expectations. Now compare that to spending. Consumer spending rose 0.5% in October and again 0.5% in November. Month after month, Americans are spending more than their income is growing. That gap doesn't close by optimism. It closes by something else. Chapter 4. The savings drain. The personal savings rate has collapsed to 3.5%. To put that in perspective, this is near levels last seen during financial stress periods. What does that mean in plain English? It means households are no longer saving. They're drawing down reserves. They're dipping into emergency funds. They're borrowing. Not to invest, not to grow wealth, but to maintain their lifestyle. Groceries, rent, gas, insurance, credit card bills. This isn't discretionary spending anymore. This is survival spending dressed up as confidence. Chapter 5. The debt time bomb. And here's the part no one wants to lead with. Credit card debt in the U.S. has now exceeded $1.2 trillion. That's trillion with a T. And the interest rate on that debt? Over 20%. This is the most expensive consumer debt environment in decades. Every swipe today is a heavier burden tomorrow. And it's not just debt. A recent Allianz survey found that half of Americans have reduced or stopped contributions to their retirement accounts. Think about that. People are sacrificing their future to afford the present. That's not confidence. That's desperation hidden behind spending data. Chapter 6. The Fed's impossible choice. Now we arrive at the Federal Reserve. They're trapped. They want inflation at 2% so they can declare victory, but inflation is stuck at 2.8% and threatening to creep higher. They've already cut rates 3 times. So what now? If the Fed cuts further, inflation risks reigniting. If the Fed holds steady or hikes again, the consumer, the engine of US GDP, runs out of fuel. Because you can't power a $27 trillion economy on maxed out credit cards forever. Eventually, the bill comes due. Chapter 7. The illusion of strength. This is the illusion we're living in. GDP growth fueled by debt, consumption driven by savings depletion, economic strength paid for by households quietly bleeding. The macro numbers look great until you ask one uncomfortable question: who is actually paying for this growth? And the answer is simple. It's not corporations, it's not Wall Street, it's not the government, it's the consumer. The same consumer being told everything is under control. Chapter 8. The final truth. America's economy isn't collapsing, but it's not as healthy as it looks. It's running hot on borrowed time, borrowed money, and borrowed confidence. Inflation hasn't been defeated, it's been tolerated. Growth hasn't been earned, it's been financed. And savings haven't disappeared by accident, they've been spent to keep the illusion alive. The data looks great, until you remember who's really footing the bill. And sooner or later, someone always does.